Today, we're taking the pulse of the commercial real estate market, and we're going to do that by zeroing in on one of its most vital signs, leasing absorption.
So think about this. How do you really know if a city's office market or its industrial market is truly booming or busting? I mean, is it just the number of cranes you see dotting the skyline? Or maybe the vacancy rates you hear about on the news? Well, look, those things definitely matter. But the real story, the true measure of supply and demand, it almost always comes down to just one critical number. And that number is leasing absorption. Yeah, I know, it sounds a little technical, but trust me. Think of it like a secret decoder ring for the entire property market. Okay, so at its core, net absorption is just the net change in how much space is actually occupied over a specific period. Usually a quarter or maybe a full year. It's basically answering one simple question. Is the market gaining tenants or is it losing them? Now, to make this super intuitive, let's use an analogy. I want you to picture the entire commercial real estate market of a city as one giant bathtub, okay? The water inside that tub, that's all the occupied space. So absorption is just the change in that water level. Is it rising or is it falling? Simple as that. Okay, now you're probably going to hear two different terms thrown around, gross and net. Let's stick with our bathtub. Gross absorption is all the water pouring in from the tap. It tracks every single new lease that gets signed, and that shows leasing activity, which is great. But net absorption, that's what we really care about. That's the final water level after you account for the water that's also going out the drain when tenants move out. It's the true honest-to-goodness measure of growth or contraction. And you know what? The math behind it is beautifully simple. You just take the total square footage that's occupied at the end of the period and you subtract the amount that was occupied at the start. That's it. That's your number. So what's this number actually telling you? Well, if it's positive, like you see here in green, that means more companies moved in than moved out. Demand is strong, the market is healthy. But if that number is negative, like the red bar, it means the opposite. More space was emptied out than was filled up, and that's a crystal clear sign of weakening demand.
Okay, so this is all interesting data, but how does this abstract number actually translate into the real world? What's the real-world impact? Well, let's break down what it means for landlords, investors, and even regular businesses.
When you start seeing sustained positive absorption quarter after quarter, it's basically a giant green light for the market. It's a clear signal that demand is outpacing supply. And for landlords, this is fantastic news. They get more leverage, they can start pushing for higher rents, and they don't have to offer as many goodies, like free rent periods. And for the market as a whole, vacancy rates start to tighten up.
And this isn't just a minor signal, it's absolutely crucial for all the big players. For an investor, a strong positive trend might be the sign they've been waiting for to buy a building or deploy more capital. But a negative trend? That could be the flashing red light telling them to sell before things get any worse. We're talking about multi-million-dollar decisions being guided by this one single metric.
But hey, it's not just about the big shot property owners. If you're a business looking for space, this number is basically your weather forecast. If you see absorption is on the rise, you know your negotiating power is shrinking by the day. It might mean you need to get moving on that lease renewal sooner rather than later, before rents really start to climb.
But, and this is a big but, like any powerful metric, it's not always as straightforward as it seems. The real insights, the juicy details, are found when you start to look deeper, to read between the lines of that headline number.
So let's play out a common scenario, just to see how this works in a wild. Imagine this, a gleaming new 200,000 square foot office tower just finished construction. The ribbon has been cut. What happens next? Okay, so this scenario highlights a really common trap. The new building, it's a huge success. It leases up a massive chunk, 150,000 square feet, right out of the gate. So the market report comes out and it shows this huge positive absorption number. Everyone's cheering. But wait a second. The total amount of empty space in the market also just went up by 50,000 square feet. And that, right there, is how you can have strong positive absorption and rising vacancy at the exact same time. It's a classic nuance.
And it's not just about new buildings either. Geography matters a lot. You might see a big headline that says the whole metro area is healthy, showing positive absorption overall. But if you zoom in, you might find a totally different story. Maybe the downtown central business district is absolutely booming, while the suburban office parks are bleeding tenants and showing deep negative absorption. You always have to dig into the submarkets.
And here's the other really crucial thing you have to remember. Absorption is a lagging indicator. It's like looking in the rearview mirror. So a market report that comes out in April showing data for the first quarter, it's reflecting deals and decisions that were made months and months before that. The actual market shift has already happened. The data is just now catching up to tell you about it.
So the big takeaway here is that while absorption is an incredibly powerful metric, it just doesn't exist in a vacuum. To truly understand what's going on in a market, you have to see it as one piece of a much larger ecosystem of data. You can really see the cause and effect, the ripple effect, right here. These metrics are all connected. Think of it this way. When positive absorption rises, it's like the first domino to fall. It pushes the vacancy rate down, which in turn gives landlords more leverage, which causes those tenant freebies and concessions to dry up. It's all part of a predictable dance. So to get that full 360-degree view, you've got to pair absorption data with these other vital signs. Things like the vacancy rate, the pipeline of new construction coming online, and this one's huge, leading economic indicators like job growth. Because at the end of the day, it's job growth that creates the future demand for all that office space.
So there you have it. Now you know how to read the market's pulse. You know the one number that tells the real story of supply and demand in action. So the only question left is, the next time you see that number, what story is it going to be telling you?